Hello everyone, I hope you all are doing great. I welcome you to another session in which we are going to be discussing IAS 40, which is on investment properties. Now, this standard is somewhat closely linked to IAS 16 in terms of how we deal with such kind of assets, but there are some slight differences which justifies why we have a separate standard on this property. As a summary, let's begin what IAS 40 is. IAS 40 investment property applies to properties held for rental income or capital appreciation. These are going to be those properties which are not going to be used in operations. Because if the property ends up being used in operation, then IAS 16 will be applicable to that property. If you're holding a property specifically for rental income or capital appreciation means that we are holding the property for the purposes of benefiting from the increase in the value of that property which will happen over the passage of time. Such kind of properties are initially measured at cost just like IAS 16, but subsequently entities can choose either the fair value model or the cost model. If they end up choosing fair value model, any revaluation gains or losses are going to be recognized in profit or loss. If they choose the cost model, they will depreciate the asset very similar to how we do it under IAS 16. It is very important to understand that entities can have transfers between the property from, for example, investment property, we can go to owner occupied, which is IAS 16, and we can also have a transfer to IAS 2, which means you can have a property which was held for either rental income or capital appreciation, but now you decide that you want to use it in the operations. Once you change the mode of the use of such property, you will have to change the accounting treatment according to the relevant standard. All right. We are going to be understanding how those transfers are going to happen, because you just cannot simply transfer. There is going to be a proper method through which you have to transfer the property between the standards. Usually what happens is they require the revaluation at fair value. Don't worry, this is just a summary. We are going to go through the detail in a while. The standard ensures consistent recognition, measurement, and disclosure of investment properties. Okay. Now, definition and scope. IAS 40 under investment property is defined as the property, land or buildings or part of the building which is specifically held to earn rentals or for capital appreciation. Now students, it is very important that you understand that for IAS 40 the property must have the purpose of either being held for rental or for capital appreciation. There should no other be any other kind of purpose. Okay, it should not be used in production or administration, because otherwise IAS 16 would be applicable to that property, and it should not be held for sale in the ordinary course of business, otherwise it will be classified as inventory under IAS 2. It should not be the case. Okay. Examples of investment property could be, for example, land which is held for long-term capital appreciation, a building which is leased out to tenants, so you earn rentals from this lease contract, for example, a property that is being constructed or developed for the future investment purposes. So you can imagine that if we are constructing a property, one of the standard which was applicable was the borrowing cost, which we discussed in the past, that if we are constructing a qualifying asset and if we are funding it through loan, then any borrowing cost would be capitalized to the cost of the asset. So normally we would think that it would be subsequently treated under IAS 16 once the asset is ready. But it is very much possible that after the construction of the asset is completed, it can be held under IAS 40 for the purposes of earning rentals or for capital appreciation. So you can increase the scope of your thought process that construction and development of future investment purposes of any property is possible. Examples of what is not an investment property: a factory that is used by the business. Why? Because it is applicable under IAS 16. Property held for short-term resale is classified under IAS 2. Owner-occupied property again will follow the IAS 16 rules. Initial recognition and measurement. Now this is very important because you will definitely be asked to have this recognition and measurement calculations in the exam. Investment property, just like any other property under IAS 16, is initially recognized at cost, which is going to be including the purchase price. Directly attributable cost, which we have already discussed under IAS 16, and excluding any abnormal cost. For example, losses from initial construction mistakes. So those losses you cannot capitalize. You will have to definitely expense those losses which you have incurred. Okay. Therefore, when recognizing investment property at cost, only normal necessary costs should be included. Abnormal costs which are not essential for bringing the asset to its intended use must be excluded. There's nothing new. This is same as what we deal under IAS 16. Those abnormal costs are as follows. Inefficiencies and mistakes, for example. If you end up making any error during construction and as a result you have incurred additional cost, you cannot capitalize that cost. Okay. Unnecessary modifications. So expenditure that do not increase the value or that do not enhance the functionality of the property will not be capitalized. They are going to be expensed. And startup operating cost, for example, if the property is vacant for a period before finding tenants, any lost rental income or related expenses cannot be capitalized. So you have to all expense it to the P&L. It's very important. This is just like how we deal under IAS 16, that only those costs that are necessary to bring the asset to its intended working condition and location are going to be capitalized. Rest, any other indirect cost are going to be expensed. Okay. IAS 40 follows the same principle as IAS 16, ensuring that the costs directly attributable to the investment property's acquisition and preparation are included in the initial measurement. If, for example, the investment property is acquired through a business combination, which means when we are talking about group accounting, the investment property that will be acquired in the process has to be recognized at fair value at acquisition date, not at cost as per IFRS 3. So in normal situation, you do recognize investment property at cost, but if you're acquiring a subsidiary and while acquiring the assets of the subsidiary, you're also acquiring investment property, then that investment property valuation in your group accounts must be done at the fair value. Okay. Now, subsequent measurement, which is extremely important. IAS 40 allows you two measurement models. Number one, you can recognize the property at the cost. You can continue to recognize it at the cost. Initially, it is going to be recognized at cost, okay, but subsequently, you can carry it at cost. The treatment is same as IAS 16, which is that you would be carrying the property at cost, less accumulated depreciation and impairment. Fair value, however, must be disclosed in the notes to the financial statements. All right. Advantage is that it is going to be more stable and less profit volatility. The reason why, because you will have a systematic allocation of the expense in the form of depreciation in your profit or loss accounts. So you will not have a lot of profit volatility. It will be much more stable. Disadvantage is that it may not reflect the true market value, especially because the property is held for capital appreciation, right? So it makes sense that we should be having information disclosed related to its fair value as well, so we can understand that what is the trend in the fair value of this particular property over time. Okay. Then you can also carry the property at the fair value model, which is more preferred. This is recognized at fair value. In this treatment, the investment property has to be remeasured to fair value at each reporting date. You have to update to reflect the current market situation of that particular property. Fair value gains and losses are going to go through profit or loss, not other comprehensive income. In IAS 16, any gain on revaluation is taken to other comprehensive income. But here, any gain or loss will directly go to the profit or loss, because changes in fair value directly affect the financial performance. So gains or losses are recognized in profit or loss to reflect the impact on earnings. Okay. No depreciation is going to be charged. This is extremely important. No depreciation is going to be charged because the fair value model assumes that changes in value Any fluctuations that happen are already reflected through revaluation, making systematic depreciation unnecessary. Because the reason is you're anyway going to update the value of the property at each reporting date. So any fluctuations, whether up and down, that occur, you're only anyway going to be reflecting that once you revalue the asset at each reporting date. So depreciation in that case will not become necessary under fair value model. The advantage of this model is that it provides relevant and up-to-date financial information, and this is true for fair value model as always. Whether we are dealing with IAS 16 or IAS 40, fair value model always provides you relevant and up-to-date financial information. The disadvantage, however, is that the market values can fluctuate, leading to volatility in profits. Because you have to remeasure to fair value at each reporting date, and because the gain and losses directly go to the profit or loss, you might expect some kind of volatility in profits. Maybe the property value can go down, which can make you earn a loss, or it can go significantly up, which gives you a higher profit. So it leads to this kind of volatility in the profits, not leading to stability, just like how the cost model provides. So once a company chooses a model for an investment property, it must apply the same model to all the investment properties unless circumstances change. So you cannot cherry pick the assets. If it's cost model, all investment properties are going to follow cost model. If it is fair value model, all investment properties are going to follow the fair value model. Now, transfers of investment property. This is extremely important. As in the beginning, we have discussed that the entity can, however, decide to change the use of the asset. It's completely fine if the entity decides to do that. If, for example, if I've acquired a property for the purposes of earning rentals or capital appreciation, maybe during the year I can decide to change the use of the asset to maybe IAS 16, owner occupied, or use in the administration purposes. Or, for example, I can hold the inventory for the purposes of the sale as a normal ordinary course of the business. If, for example, I'm someone who's doing the sale or buying of the property, and I decide that, okay, I also want to sell this property, then that will be categorized under IAS 2. So it's very normal for the entities to do that, but you must understand how these transfers occur. Let's discuss situation number 1, which is investment property. We decide that, okay, let's go to the investment property. Okay, we can decide that let's go from investment property to IAS 16. If you decide to do that, you have to, number 1, revalue to fair value before transfer. So you will update, you will check at date of transfer what is the fair value, and you will update the value of that investment property to the fair value. The fair value at transfer of date becomes the new carrying amount under IAS 16. Then subsequently, with that valuation, you will treat the asset under IAS 16. Now your question should be in this case that if you are revaluing the asset to the fair value before transfer, where does the gain or loss go on that revaluation? It will go to the profit or loss. Okay, because at that point in time, you're revaluing before transfer, the revaluation is happening under investment property IAS 40. So that will go to the profit or loss. You can also go from investment property to IAS 2, very common, not a problem. What you will do, again, at before transfer, you will revalue to the fair value, and the fair value at transfer date becomes the cost of inventory under IAS 2. That is what you will be taking under IAS 2, which will form the cost of the inventory. Again, if you are revaluing to fair value, where does the gain or loss go? The gain or loss will go to the profit or loss, because we are revaluing this under IAS 40, right? Before transfer, what is the standard applicable? IAS 40. So that gain or loss will go to the profit or loss. Then we can go from IAS 16 to investment property. We can go, it's very common, we can go from IAS 16 to investment property. In that situation, you will revalue under IAS 16 before transfer. If there is a gain, then you know where the gain will go. Where does it go? You tell me. It goes to the OCI. We all know that. If it is a loss, we all know it will go to the profit or loss. We've already talked about this. If you're unsure, go back to my previous videos. We have discussed the subsequent treatment under IAS 16. Okay. Then loss will go to the profit or loss unless reversing a previous gain, then it goes to the OCI first. So if you have a previous gain sitting related to that property, then you have to take that loss and first eat the revaluation gain before taking the net loss to the profit or loss. Okay, this is just a revision statement. Don't get confused. So if, for example, you have IAS 16 to investment property, once you revalue, the gain will go to the OCI, any loss will be taken to the profit or loss. Clear? On the other hand, lastly, you can also have IAS 2 to investment property. You can decide I want to go from IAS 2 to investment property. Again, you will revalue to fair value before the transfer. The fair value at transfer date will become the carrying amount under IAS 40. Then subsequently, you can decide if you want to carry that under the cost model. So for example, the carrying amount will then subsequently be depreciated, or do you want to carry it under fair value model? It's all up to you. But once you transfer, you have to revalue it at fair value. Where does the gain or loss go? The gain or loss will go to the profit or loss. Okay, this is a very great summary table. You can take the screenshot if you want to. It will help you remember the types of the transfer and their treatments. Then lastly, we have disclosure requirements under IAS 40. So you must disclose the measurement model, whether you're measuring it at fair value or cost. If the fair value is used, any gains or losses are recognized in profit or loss. So you must disclose the gains and the losses that have occurred due to the revaluation of investment property. If the cost model is used, the fair value must still be disclosed in the notes. Any restrictions or contractual obligations related to the investment property must also form part of the disclosure notes. Okay. And therefore, to conclude the session for today on IAS 40, this is the summary table that you can use to have clear points of the things that we have discussed so far. So remember, students, IAS 40 is simply the property that is held for rental income or capital appreciation, not for your own use. If it is for the own use, it's IAS 16, not IAS 40. You can initially measure it at cost, including directly attributable cost. If you want to know the directly attributable cost, please go to my video on initial recognition on IAS 16. I've discussed these costs in detail. Subsequent measurement, you can decide the fair value model in which you will charge no depreciation, and any gains or losses will go to the profit or loss because you will have to update the value of the asset at each reporting date. Okay. But if you decide the cost model, depreciate it normally under IAS 16. So it's same as what you will do under IAS 16. You have what we call transfers to different standards. So you must revalue to fair value before the transfer, and treatment will vary depending upon where the shift is happening and from which standard to what standard. And this has just been summarized in the table I have given you above. Profit or loss impact if we are dealing under fair value model. Any changes in the fair value will be reflected under profit or loss, unless IAS 16 where gains are taken to OCI. So this is a very important distinction between the two standards. The disclosure must be that you must state the valuation model, whatever you are using, and provide assumptions used for the fair value measurement. So students, this concludes our session on IAS 40 today. I have just discussed the theoretical aspects on this standard because in the next session, I'm going to be discussing with you the questions on this standard, and I'm going to go through details. So make sure you do not miss that video out. If you have any confusion right now, it will all be cleared in the next video. If you have liked my video and have found this video to be helpful and useful, please consider liking this video and subscribing to my channel. And I'll see you in the next video. Till then, take care and have a nice day.